Okay, let's go ahead and get started. Welcome everyone to the All Things Forex Outlook webinar for the new trading week ahead of us. My name is Ilian Yotov. I am the creator of the Quarters Theory, the founder of allthingsforex.com and tradertape.com, a couple of websites that I'm inviting you to visit. And if you would like to follow along with me during the trading week, after this webinar, Monday through Friday on my website, allthingsforex.com, I do a daily broadcast called the All Things Forex broadcast, 8 to 9 a.m. Eastern Time every day, Monday through Friday. So make sure to listen to that. And before we continue, I'd like to thank our friends at fxstreet.com for putting together these series of webinars. And I would also like to remind you that today's program is not intended for as giving any buy, sell, or hold recommendations. It is intended for educational and informational purposes only. So we're going to talk about what could be another tumultuous trading week on the markets, especially considering the developments from Friday night when S&P, the Standard & Poor's credit ratings agency, decided to downgrade the U.S. credit rating, which has never been done, and now the U.S. credit rating is from AAA lower down to AA+, which is still a pretty safe grade. However, we're more than likely going to see the impact of the credit rating cut of the United States in the markets. I would have to say that we're more than likely going to see some very much of a volatility in the stock markets tomorrow morning, and we need to be very, very cautious as the market reacts to that historic event, actually. It's never been done before. So it's going to be a busy week, not only because the markets could be on the edge as investors react to the U.S. credit rating downgrade, but also investors remain unconvinced that the worst is behind us when it comes to the European debt crisis. And on top of that, as if that is not enough, we're also going to see the Federal Reserve announcing their interest rate decision on Tuesday, which is going to be the number one event for us as far as important economic events throughout next week. So let's not waste any time and start with the very first one, which I've chosen to come on Monday night from China. China is the second largest economy now in the world. Earlier this year, it took the second spot from Japan. It is also the fastest growing economy in the world. However, China's been slowing down recently as a result of the efforts from their own government and their own central bank, the People's Bank of China. The reason? The rising inflationary pressures, which also, according to some experts, are actually getting out of hand. In the month of June, inflation came up to 6.4% year over year in China. And the consensus forecasts are expecting inflationary pressures to remain elevated at the same level, 6.4% year over year, again in the month of July. What that means is that as long as inflation continues to stay high, the People's Bank of China, the Chinese central bank, is more than likely going to continue to implement the necessary measures in order to bring inflationary pressures down, to contain inflation, which have been two very important measures: raising interest rates, raising the benchmark interest rate, and along with that, raising the reserve requirements for Chinese banks. All of that is an effort to curb inflationary pressures that are rising, but on the other hand, coupled with other measures that the Chinese government has undertaken, all of these measures come together and they cause an economic slowdown. Again, it's not a drastic slowdown, but it is a slowdown that we're seeing in Japan. So as long as Japan slows down, the impact for us currency traders is going to be, especially if one is following the Australian dollar, the impact is going to be that a slowdown in China could definitely reduce the demand for Australian raw material exports. And China is the largest trading partner of Australia, second largest trading partner for New Zealand. So both of these currencies down under, the Aussie and the Kiwi, could suffer the consequences as a result of Chinese economic slowdown. On top of that, we have seen both of these currencies the Aussie and the New Zealand dollar, coming under significant pressure in recent week or so as a result of the market drought, massive risk aversion, declining commodity prices, and so forth. All of these are not the kind of fundamental factors, if you will, that are going to be beneficial for higher yielding commodity currencies such as the Australian and the New Zealand dollar. So let's go ahead and take a look at both of these two currencies down under. And let's see here. Let me move this screen over here to the right a little bit. Get this one closed. And we'll take a look at the daily chart of the, let's start with the Australian dollar, Aussie versus the US dollar. Now we have noted that Australian dollar has been trading somewhat in a range here in the last several months. The range that was established was a little bit of a smaller range here. That was the previous record high, by the way. But the previous smaller range that the Aussie dollar exchange rate was confined within was this range between approximately $0.0440, and then we had some identical resistance levels here, a little bit below $1.08, a little bit above the large quarter point, an important price level in my quarters theory, which is the $0.0750, large quarter point. You will recall the triple top resistance that we've discussed in recent weeks, that the Australian dollar had problems breaking above. 3 consecutive times it met that steep resistance at the top of the range. No surprises there, but finally, with the dollar weakening, the Aussie managed to break out above the top of the smaller range, and then on top of that, it broke above the previous record high, which was $10.11, and it managed to produce a brand new record high at the $10.79. However, with the market drought, with risk aversion, renewed uncertainty about the European Union debt crisis, the debt crisis in the United States, the austerity measures that could possibly slow down the economy and so forth, the Australian dollar started coming under pressure and very significantly has sold off from the record high at the $10.79 to reach on Friday as low as $0.0374. $0.0374 is just a little bit below that previous low at the $0.0391, which was a little bit of a overshoot below the move below the bottom of that channel. So now we have an attempt after the breakout outside of this smaller channel. We now have an attempt for the Australian dollar to break decisively again below the bottom of that previous channel. And it seems like as of Friday's trading session, we have I wouldn't say that's a significant breakout below that support level because it's only from $0.0391 down on Friday to $0.0374. We're down only 17 pips. And my personal preference, and I explained that in my book, The Quarters Theory, as one of the rules of thumb, if you will, that I have created in my methodologies, that I would require for a price move below an important support level or above an important resistance level, I would require that move to be at least larger than 25 pips in order to show me that there is a good momentum, that there is an actual breakout that is occurring. Because anything, to me at least, below 25 pips is what I would consider as an overshoot, above or below an important support resistance level, and not necessarily a decisive breakout. So what happened on Friday, that low, I wouldn't necessarily call it a decisive breakout, but it is the first attempt, and normally on a first attempt, we may not see the breakout occurring. If we continue to test that level, however, and it looks like the Aussie dollar exchange rate is lingering still around that area, so in the days ahead, if we continue to test that level, we could see potentially further losses for the Australian dollar versus the US dollar, especially if we get to more risk aversion and uncertainty persisting as a market environment. Now, the New Zealand dollar has also sold off versus the US dollar significantly, but not necessarily breaking below important level just yet. That first important level and that was the previous record high, by the way, that we looked at a few weeks ago. That was at a little bit above the large quarter point at 0.85 cents. Then the New Zealand dollar broke above it, and it reached a new record high at 0.87, no, 0.8842. That was the high of August the 1st. Since then, the New Zealand dollar has come under pressure. On Friday, it dropped as low as 0.8273, almost within at least 25 pips from the large quarter point. At 0.8250, we got it to stay above that large quarter point, but that's the first area that we're going to watch heading into the new trading week ahead of us, especially because previously it had some resistance here, right around 83 cents area. So that previous resistance can now turn itself into a level of support. If it is broken, and if we break below the large quarter point at 0.8250, the next area of support is going to be 0.8110. And if we break below this level, just a little bit below that, we have the major large quarter point, of course, which is the 0.80 cents. If we start breaking below 0.81 and 0.80 cents level, then that would be very serious development, because it's going to basically indicate that we may have a little bit more of a larger price correction that the New Zealand dollar is undertaking. What do I mean by saying that? Well, we have the New Zealand dollar versus the US dollar pretty much in a strong bullish trend since March of this year. It started from around 0.71 cents area, and it went all the way as high as 0.8842. So we're talking about more than 1,700 pips of a gain for the Kiwi against the US dollar since May, in just a few months. So if this is a 1,700 pips of a range, and the New Zealand dollar has already started a significant price correction, if the market decides to go with the so-called perfect 50% retracement, what would be exactly 50% on 1,700 pips? It will be 850 pips. From the highs here at 0.88 and a half area, which is 0.8842 as the record high, right? 850 pips of a decline. That would bring us down to the 80 cents area. So that's why I'm saying the 80 cents area is going to be a crucial level, because if the New Zealand dollar begins to break below that level, then that would mean a more significant price correction. Then we could target this support area, which is around the large quarter point at 0.7750. You might recall the low from May the 16th at 0.7756. I'm sure for those of you familiar with my quarters theory, that is not a coincidental number. It is a large quarter point. There's an important level. But if the Aussie breaks below 0.80 cents, could we see it go to the next 0.7750 large quarter point? I would think so. But if the New Zealand dollar, if the New Zealand dollar, however, stays within that normal retracement up to 0.80 cents area and does not break below it, then that's still just a retracement of that strong bullish trend. It would not, in other words, mean that the trend, the bullish positive trend of the New Zealand dollar versus the US dollar is reversing. Okay? So as long as we stay above 0.80 cents and as long as we stay above the large quarter point at 0.7750, which would be approximately the 61.8% retracement level, it would be a larger price correction up to 61.8%, but it would still not mean that we are making an attempt to reverse that trend. Now, it will be a different story if we break below 0.7750. That would mean a warning sign of a possible reversal and a potential exact 100% retracement all the way down to the almost 0.71 cents level. But for the time being, this is a few days. It's a serious sell-off. It's a significant decline, but it's still just a small percentage of a price correction. It's about, 30% or so, from 0.8842 to the low on Friday at 0.8273. It's about 600 pips on 1,700 pips gain. It's about 31.8% or so retracement approximately, which is the a normal Fibonacci retracement level. Also, another thing when it comes to these retracements for the Aussie and for the Kiwi dollars, the more significant the price correction is, the more traders could be looking for an opportunity to reposition themselves at lower price levels in anticipation of these strongly established bullish trends to continue further. So there's a couple of ways to look at these retracements, either take advantage of them or patiently wait, and as traders patiently wait and consider repositioning at lower price levels. Now let's move on to our next spotlight event for the week next week, which is going to come from the United Kingdom. We'll have two important events next week from the UK. After the Bank of England decided to sit on the sidelines, which was not surprising whatsoever, on Thursday they decided to keep interest rates at their record low 0.5% level and did not expand the size of their so-called asset purchases program. We are now going to look at the industrial production from the UK on Tuesday, and also on Wednesday, another major event from the United Kingdom is going to bring us the Bank of England inflation report, which we'll discuss in a few minutes. The United Kingdom's industrial production is the main measure of industrial activity, and obviously we have seen some signs of a slowdown not only in the United Kingdom but also worldwide. The UK economy is not an exception, and we're expecting a smaller increase of the UK industrial production by 0.4% month over month in June. That is going to be lower than a 0.9% month over month increase in May. So potentially another sign of a slowdown in the UK economy. It's going to be dependent, however, when it comes to the British pound trend, whether or not the US dollar is going to significantly weaken as a result of the market's reaction to the credit rating cut and so forth, and especially what the Fed is going to say on Tuesday. So this is going to be an important report, but not as important as the next major spotlight event, which is going to come from the United States with the Federal Open Market Committee interest rate announcement on Tuesday afternoon at 2:15 p.m. Eastern Time. Now, much has been said about the Federal Reserve's monetary policy. It's pretty much the same monetary policy for years now. The Fed is keeping interest rates at a record low, historically low level in a target band between 0 and 0.25%. They have not been changed for years, and more than likely they're not going to be changed until at least, if not the second half of next year, maybe even some are saying until 2013, maybe even throughout the entire 2012. The Federal Reserve will have no other option but keeping interest rates low for that, quote, extended period that they have been, same language they have been using in their statements. Now, in recent several weeks, we've seen some very definite signs that the U.S. economy is slowing. In the second quarter of 2011, we had slower economic growth by only 1.3%, compared with 1.9% in the first quarter. We have seen several indexes of manufacturing services sectors not showing us very strong readings either, falling back. There's other sectors of the economy that are slowing down, and on top of that, the Fed's preferred gauge of inflation is not rising as much as the Fed would like to see it. So, in other words, the economy is slowing. We're not having a whole lot of significant improvement in the U.S. housing market or the job market for that matter. Now, on Friday, we had a little bit better than expected non-farm payrolls report, but to me, that's not a game changer. It doesn't mean that we are seeing that significant improvement that the Fed is looking for from the U.S. labor market. As a matter of fact, some estimates are saying now that the U.S. economy has to create at least 125,000 new jobs every month just to keep with the pace of population growth. Just to keep, in other words, the current unemployment rate, which is 9.1%, at the same level. We have to create 125,000 jobs a month. Well, we had dismal jobs creation in June and also in May. In June especially, with only 118,000 jobs. Now, in July, we saw 117,000 according to the report on Friday, but that report is not final. It could be revised lower, such as we've seen the previous reports being revised. In other words, the Federal Reserve will be in no hurry because of this weak economic data from the United States to start tightening their monetary policy anytime soon. I'm sorry, that's not Tuesday, August the 2nd. You're absolutely right. Thank you, Brenda. It's actually August the 9th. Must have missed that in a hurry there. So it's Tuesday, August the 9th. Thank you very much for noticing that. I can't fix it now because I have to stop the presentation, but thanks for the note. So possibly even until the second quarter of 2011, the Fed could be on the sidelines as far as hiking interest rates. Moreover, it's going to be interesting on Tuesday if, especially now with the U.S. government announcing that they're going to cut up to $2 trillion and announcing some new austerity measures. We have the economy already slowing. We have new austerity measures that are being announced. With those two factors, we'll see whether the Federal Reserve is going to open the door to quantitative easing number 3, which we all know what QE number 1 and QE number 2 have already done to the U.S. dollar. They were not really beneficial for the U.S. dollar trend. So QE number 3 could potentially be a factor that also weighs on the U.S. dollar if the Fed makes any announcements or any hints that there will be another round of quantitative easing. Now, some experts are saying, well, the QE number 3 is probably going to be half the size of QE number 2 because QE number 2 was half the size of QE number 1, which QE number 1 was over $1 trillion, 1.2 or 1.3 trillion. QE number 2 was about 600 billion rather, which was half the size. And now some are estimating that QE number 3 will be smaller, 300,000 or 300 billion rather. So we'll see what the market's reaction is going to be, but it's a major risk factor, in other words, for the U.S. dollar if the Fed opens the door to more asset purchases, treasury bond purchases, quantitative easing program expansion, and potentially further debasement of the U.S. currency. Now, on the other hand, throughout next week, we're also going to pay attention to what's happening on the other side of the pond in the Eurozone, because we've had a market drought in Italy. We've had some interesting developments there. Investors remain unconvinced that the worst is behind us when it comes to the European Union debt crisis. So definitely a lot of things to pay attention to throughout next week. The Bank of England's inflation report is going to follow the Fed, and that's a number 2 major spotlight event for us next week. In its previous assessment on inflation, the Bank of England said that they're expecting inflationary pressures to peak above 4%, and then eventually to begin to subside after that. Now, we have seen them peaking significantly above the 4% level. They actually were at 4.5% year over year, the consumer price index was, at 4.5% year over year in May. Now, they have pulled back in June from 4.5% to 4.2% year over year. So it looks like they may have started to subside. Now, with commodity prices already, the world slowing down, according to the latest economic data, and commodity prices already beginning to pull back, that also could cause inflationary pressures to continue to subside in the UK. What does that mean? If the Bank of England, in other words, expects that inflationary pressures will continue to fall and move lower, and ultimately potentially even move back below the 4% level and get closer to the 3% level, which is their ceiling, that still would mean that inflationary pressures are above their ceiling, above 3%, but at least they're beginning to subside. And that's not going to be the environment, subsiding inflationary pressures and a slowing economic growth in the United Kingdom. To me, it's not going to be the environment where the Bank of England policymakers decide to start raising interest rates or tighten monetary policy. As a matter of fact, some estimates are not expecting the Bank of England to raise interest rates at least until the second half of 2012. So if that is the case, that means the Bank of England continuing to sit on the sidelines. However, we've seen, obviously, the market just a few months ago was expecting the Bank of England to start hiking rates in May. They didn't. So the market began to reprice these expectations. However, in a recent environment, I think it's an important question to ask ourselves, can the British pound provide an actual better alternative than the troubled US dollar and the euro? Because we're seeing debt crisis in the Eurozone, we're seeing a debt crisis in the United States. Could the British pound all of a sudden become a better alternative as a maybe a little bit less ugly currency of choice? Now, let's go ahead and take a look at the daily chart of the pound versus the US dollar and see what's been happening recently as far as trend developments are concerned. And this is the daily chart of the pound-dollar pair. We know that for the last several months, at least since February, the pound-dollar exchange rate has been trading within a range. And the range has been between $1.59.11, which were some recent lows here, and the top of the range a little bit below the large quarter point at the $1.67.50. So what does that mean? It means that the pound-dollar exchange rate is simply trendless. It doesn't have a trend, this currency pair. It's simply fluctuating in a clearly well-established range. Now, it looked like a few weeks ago, as we discussed in our previous webinars, that the pound-dollar pair made an attempt to break below the bottom of that existing range. It reached as low as $1.5779 on July the 12th. The problem is, however, with the dollar weakening, the pound-dollar exchange rate went right back into its previously established range. And in recent week or so, it has been bumping against some previous resistance areas that are around the important level in my quarters here, which is the $1.65 level. Earlier this week, the pound reached as high as $1.6474, which is only about 26 pips below the large quarter point at the $1.65. Today, so far, we have exactly the same identical high, which is $1.6476, within 2 pips, a little bit higher, 2 pips higher than the high earlier this week. So this is obviously an important area that we're going to have to watch, because a break above that level could then very quickly send us to $1.65, and then even challenge the next resistance level, which is $1.6546, or $1.6546. That is the high from May 31st. So now it looks like the pound in the last several weeks has managed to stage a nice little bullish trend wave sequence, as I would call this, development. And the only way that sequence is going to continue is if we break above these resistance areas, which generally speaking fall within the vicinity of the large quarter point around the $1.65. So $1.65, $1.6546 are the most immediate resistance areas to watch. A break above these areas are going to be a bullish technical development for the pound versus the US dollar. Why? Because they're going to open the door, a breakout above these resistances is going to open the door for the pound-dollar pair to target the ultimate top of that range since February, which is the large quarter point at the $1.6750 and the high at the $1.6745 from April 28th. So that is the implication of the pound clearing this cluster of resistance levels. And I'm talking about a cluster because there's a ton of them, but the most important ones are $1.6476, the large quarter point at the $1.65, and then a little bit above it is the $1.6546. So a decisive break above that, if the pound all of a sudden becomes that better alternative compared with the US dollar or the euro, it might attract some bids and may have a chance, potentially. that is provided the markets do not lose 500. The stock markets around the world don't lose 500 points a day throughout the next week. So after the Bank of England's inflation report, our spotlight events are going to continue further with news from Australia. The Australian employment situation and unemployment rate is due on Wednesday night at 9:30 p.m. Eastern Time. This is the main gauge of employment trends and labor market conditions, and we've seen a slowdown around the world, and it looks like the Australian economy is not going to be creating as many jobs according to the consensus forecast. In the month of June, the Australian economy created 23,400 jobs in June. The consensus forecasts are expecting 10,300 new jobs in July, which is less than half of the jobs creation we saw in the month of June. What does that mean? Signs of a slowdown in China with rising inflationary pressures that could prompt officials there to continue to press the brake pedals could have a negative impact on Monday night on the Australian dollar. And a slower jobs creation on Wednesday could also send a signal that the Australian economy is beginning to slow down. What does that mean? It means that the Reserve Bank of Australia is not going to be in a hurry to start hiking interest rates anytime soon. Now, the Australian interest rates, the benchmark rate there is at 4.75%. It still gives significant yield advantage to the Australian dollar over lower yielding currencies such as the US dollar or the Japanese yen. Obviously, if commodity prices were to start spiking up again, and if we get to see a revival in investors' appetite for risk, the Australian dollar could benefit in that environment. But signs of a slowdown around the world, in China and in Australia, are not going to be very good fundamental backdrop factors for the Australian dollar. So that's something to watch throughout next week. Following the Australian employment report, we're going to see the third most important event next week that I have chosen to be the European Central Bank monthly bulletin. Now, normally on a monthly basis, they release that. The European Central Bank releases that every month, and I don't normally include that in a list of top 10 events for every week. However, with all that's been happening in Italy, in stock markets there, concerns that the larger economies such as Italy, Spain are going to be impacted by this debt crisis, and the crisis is going to spread, the European Central Bank last Thursday decided to keep interest rates unchanged. That was not a surprise. But what the European Central Bank decided that was important on last Thursday, at their monetary policy meeting, is that they decided to resume their bond buying program. Now, this is an attempt to continue to buy Greek, Irish, and Portuguese debt in order to alleviate the market's concerns about the European debt crisis spreading. But experts are saying that the European Central Bank, by buying Irish and Portuguese bonds, is aiming in the wrong direction because the fire is actually now spreading to Italy and Spain. So according to some experts, the European Central Bank is going to have to start buying Italian and Spanish bonds. There's already been some talks over the weekend with the European Central Bank president that I think Mr. Trichet discussed this with the French president, with the German chancellor, potential for the European Central Bank to begin to buy Irish and Spanish bonds. If that is announced, that obviously could be a step towards assuring investors attempting to contain the debt crisis. If the European Central Bank by Thursday's monthly bulletin release has not announced that, then obviously that is not going to be very well received by the markets, in my opinion, which could continue to be concerned about the problems, the debt crisis in the Eurozone. In other words, throughout next week, I think it's going to be important to watch which one is going to be more in the focus of the market. The European debt crisis or the credit rating downgrade by the U.S., which was, by the way, already expected. I think that a lot of it was priced into the exchange rate of the US dollar so far. Now we'll see, of course, the market's reaction in stock markets around the world as well. Over the weekend, we had some G7 discussions. After a week which saw $2.5 trillion wiped off of the global markets because of the decline in equities, finance ministers and central bankers of the group of 7 major industrialized nations have been discussing on Saturday and today, having discussions with each other on some of the steps and maybe a coordinated action to address any kind of market rout. So we'll see what that means. What does that could potentially mean for the currency markets? Well, we already saw the Bank of Japan intervening again, and I see that Hafiz is asking about the Swiss franc outlook. That could potentially mean also that the Swiss franc strength is going to be considered by the central bankers of the group of 7 nations. And maybe the Swiss National Bank could be the next in line as a major central bank to intervene to curb the strength of their currency. Now, before we take a look at the Swissy, let's take a look at the euro-dollar currency pair. And I'm going to switch over here the screens for us. And we'll take a look at the daily chart of the euro versus the US dollar. As I mentioned with the pound versus the US dollar, that it was trendless, so is the euro-dollar exchange rate. Completely trendless, especially here in the last couple of months. The range is a clearly established range between $1.3969 serving as the bottom of the range, and the top of the range is a little bit below $1.47 level, with the highs at $1.4696 on June the 7th. Just as the pound-dollar pair breaking below that previous bottom of the range, the euro did the same thing, and it reached as low as $1.3837. But then with the US dollar, the focus shifting on the US debt problems and the debacle with the debt crisis and the disagreements and so forth to raise the debt ceiling and so forth, the US dollar began to weaken, and the euro took full advantage of that, and it moved right back in its previously established range. After a brief rally here for a couple of weeks to about $1.45, what was that high here? $1.4536. The euro pulled back, but on the way down, it did not break below the bottom of the existing range, which is a little bit below $1.40. As a matter of fact, now the market is pushing the euro higher to an intraday high so far today at the $1.4426, obviously as a reaction to the U.S. credit rating downgrade, the historic event that we're seeing. So what the euro could do, if it continues to strengthen, is challenge that previous high from earlier last week. And then ultimately that high was $1.4453. We're so far not too far from that level. It's intraday high at the $1.4426. So we're going to see whether that level of resistance is going to be broken above. If it is, then the euro could continue further, challenge the highs above $1.45. Just above $1.4536, the recent high. We have another important resistance level at the $1.4577. You might recall that high from July the 4th. Those are the resistance areas that the euro has to break in order to challenge the top of the range around the $1.47 level. As long as the euro remains below these highs, below these resistance levels, we can still continue to see the top of the range not being broken and possible further fluctuations within this range. That doesn't mean that when we're range bound, there is no opportunities, but right now the euro is sort of in the middle of that range, and it's really not that interesting to me. And on top of that, we do not have a very clear trend when it comes to the euro-dollar exchange rate. Now, let's compare this range-bound fluctuations, which some days, especially Friday, if you were paying close attention to what the euro-dollar pair was doing, it was a roller coaster ride. But it's expected when you are lacking any kind of strength or trends, you got a ton of volatility. And that volatility and range-bound fluctuations, I think, could more than likely continue throughout next week. Now, let's compare this range-bound fluctuations and activity with the following currency pair, which is the euro versus the Swiss franc. Now, let's make this. Okay, hold on one second here. Okay. I got a little bit of a bug in my system. Alright, forget about it. Let's take a look at the dollar versus the Swiss franc. It's another currency pair that has a very clearly established trend. Now, this is an actual trend. The previous chart, the euro-dollar pair, was trendless, trading in a range in a sideways channel. This is an actual trend, which is a very strong bullish Swiss franc trend, and that's a pretty similar chart if you take a look at the chart of the euro versus the Swiss franc. Very strong downward trend. It's a multi-year trend for the euro, for the Swiss franc. I'm not blaming the markets actually for continuing that trend, simply because what are the other alternatives at this point? I mean, we have debt crisis in the Eurozone, we have a debt crisis in the United States, we have a credit rating downgrade of the United States. So the Swiss franc is a natural alternative in this environment. Problem is, however, in the risk event for the continuation of the Swiss franc strengthening is I think the verbal intervention that came last week by the Swiss National Bank President, Philipp Hildenbrand, who stated that there is an absurd overvaluation of the Swiss franc, which risks causing a market slowdown in the domestic economy in Switzerland, and also threatens to trigger deflation. He said that these risks have become so large that the Swiss National Bank has decided that it can no longer just stand by and watch. Now, Mr. Hildenbrand said this, which I consider to be an actual verbal intervention attempt. He said, quote, "We will not stand idly by and accept a further appreciation of the Swiss franc." He said, "I don't mean that symbolically. Rather," he said, "it's a signal." End of quote. So I think these are some very strong words, and I think that the Swiss franc trend is very, very strong, and the only thing that could stop that trend is either miraculously the Federal Reserve coming on Tuesday and saying we're going to raise interest rates, which I don't think is going to happen. So in other words, an exit from the Federal Reserve's ultra-accommodative monetary policy could stop this trend. But I don't think the likelihood of that is very high. The other thing, which in my opinion there's a higher, greater likelihood to happen, is for the Swiss National Bank to actually intervene. And it possibly could be a multilateral intervention. I've been saying all along throughout last week that the Bank of Japan has been getting closer and closer, and about a day before the intervention, I said this is the language is getting stronger by Japanese officials. I think it's only a matter of time. It's not if, it's a matter of when the Bank of Japan intervenes. And certainly the Bank of Japan intervenes. So now I can say with that statement from the Swiss National Bank president, which came last Friday, if I'm not mistaken, I think it's a very strong statement, and we should take these words to mean that the Swiss National Bank is that much closer to an actual intervention. So the next thing that could stop, at least temporarily, the Swiss franc ascent versus the dollar or the euro is an actual either solo intervention by the Swiss National Bank or potential multilateral intervention between the Swiss National Bank and other major central banks of the G7 major industrialized nations. On top of this, what gets us closer to a Swiss National Bank intervention is the fact that the Swiss Consumer Price Index show a pretty hefty decline. if you paid attention to the report last week, in the month of July, consumer prices fell 0.8% month over month. So that brought the annual inflation rate from 0.6% in June to 0.5% in July. So as long as we continue to approach that 0% level, one of the biggest concerns, and the reason why the Swiss National Bank actually intervened recently, last year, was because of the threat of deflation. So the Swiss National Bank president's statement said that this is deflationary, these record highs, continuously record highs for the Swiss franc, the unstoppable bullish trend of the Swissy in appreciation versus the dollar and the euro are ultimately a threat. They could trigger deflation. That is not what the Central Bank of Switzerland wants to see. On top of that, consumer prices are now beginning to pull back toward the 0% level. Below zero, of course, means deflationary pressures. And I think we're getting closer and closer. If the market rout continues, if the Swiss franc rally continues throughout next week, I think it will be a matter of time. Possibly next week we could witness a Swiss franc intervention. Today's low for the US dollar versus the Swissy is it a new record low? Well, yeah, it is. The Friday's low was 0.7578, which was a new record low. Today we're seeing a new record low at 0.7557. So we're approaching the 0.75 cents area, and we'll see if the decline continues below these levels, below 0.75. I think that the chances are going to be pretty high that the Swiss National Bank steps in, or maybe alone or with other central banks. Now, after the European Central Bank monthly bulletin, we're going to see the jobless claims out of the United States. It's an important gauge, weekly gauge of employment trends and labor market conditions. We are very far still from jobless claims reaching below 375,000. Now, if you listen to this webinar on a regular basis, you know that we've discussed that 375,000 level is the level to watch when it comes to jobless claims. Economists are estimating the jobless applications would need to fall below 375,000 in order for us to see a significant decline in unemployment in the United States. So it could be, in other words, a leading indicator of an improvement in the U.S. jobs market. Well, have we seen that in recent months? Certainly not. Jobless claims have stayed above 400,000 for a number of weeks now. Last week they reached exactly 400,000 in the previous week. Next week they're expected to reach 402,000. Again, we're not getting close to the 375,000 level, and we're not breaking below that level. So that should tell us there's still not a significant improvement in the U.S. jobs market. In other words, it could be another weak jobs report next Thursday from the United States. The Eurozone industrial production is also due on Friday at 5 a.m. Eastern Time. And despite of the drop in the manufacturing purchasing managers index earlier this week, the Eurozone industrial production might hold up according to the consensus forecast. It's going to increase, according to the forecast, by only 0.1% month over month, which is a very insignificant increase, same as the 0.1% month over month increase in June. Yet another sign of the industrial activity in the Eurozone also slowing down. Another major spotlight event is a gauge of consumer spending from the United States next week. 2/3 of the U.S. gross domestic product depends on consumer spending. Consumer spending, in other words, is 2/3 of the gross domestic product of the world's largest economy. So consumer spending is very, very important, and retail sales are an important gauge of consumer spending. Now, that could be the only positive economic event next week from the United States. According to the consensus forecasts, the retail sales are expected to rise by 0.4% month over month in July. That is up from 0.1% month over month in June. The core retail sales gauge, which excludes automobile purchases, also is expected to increase by 0.2% month over month in July from 0% flat in a previous month. So this could be a positive U.S. economic report. However, it will all depend on what the Federal Reserve does. And the consumer sentiment is also due next Friday. This is expected to show a reading of 63.3. It's a preliminary estimate for the month of August. That would be a little bit lower than 63.7 in July. I wouldn't be surprised if the consumer sentiment index is even lower than that, considering the stock market rout, the debacle with the debt ceiling, the credit rating downgrade of the United States, and still pretty high food and energy costs in the United States. In other words, a sequence of unimpressive economic data from around the world, central bank announcement from the Federal Reserve, obviously very, very crucial event, and of course, we'll pay close attention to the European debt crisis as well as the market's reaction to the credit rating downgrade from S&P on the United States credit rating. I'd like to invite you to listen to my daily live, All Things Forex live daily broadcast Monday through Friday, 8 a.m. to 9 a.m. Eastern Time. You can listen at allthingsforex.com. If you missed the live program, I replay it for 12 hours after the live program. And also, we archive all of the broadcasts. You can find them on the members page of allthingsforex.com. All right. Well, that is all the time that we have for today's program. I haven't really caught up on, we have a question from, I don't know, Elemental One. He said, did you grasp any info about the outcome of the European Central Bank meeting today? I knew that there were some meetings. I knew that the G7 ministers are meeting. I haven't really checked the headlines here in the last hour since we started the webinar, but it looks like the dollar is falling, the stock futures are plunging. We might have some sort of a rout on Monday. It looks like the French president and German chancellor called for their parliaments to approve by the end of September strengthening of the euro area bailout fund. That was a very important thing, and one of the weak spots, by the way, from the meeting. It looks like we had some promising developments from the European Union summit a couple of weeks ago, which really kind of helped the euro, but there were some weak spots, and the biggest concern was that there's not enough ammunition, if you will, in that European Financial Stability Facility Fund, which is only 440 billion euros, and some are estimating that it has to be at least 3 times or 4 times larger than what it is now. So we're now seeing these officials calling for strengthening of that bailout fund, which means possibly increasing the size of it. And European Central Bank's role, it looks like, has been backed up today to determine when bond buying is needed to stop the contagion. So there's also some steps that are supposedly being taken by Italy, Spain, and so forth. It's going to be a very interesting week. Make sure to pay close attention to the headlines because new developments are happening on an hourly basis. So make sure to keep an eye on these headlines. I'm running out of time. Thank you all very much for attending today's webinar. I will see you again next Sunday, and we're putting together with FX Street a big 3-hour webinar, which is coming up on the 18th of August. So save the date, August the 18th, 3 hours of a webinar that we're planning with fxstreet.com. For now, thank you very much for listening. Have a great week, and I'm looking forward to seeing you again next Sunday.